top three things in my notebook this morning. Number one, the Russell 2000, we'll go with that. Number two, the 10-year bond yield, actually in Germany I want to focus on specifically. And then finally, volatility. First on the Russell 2000, interestingly, but maybe not surprisingly, the Russell has a very positive relationship. In other words, it goes down when the dollar goes down with purchasing power in America. So again, we like the Russell with the dollar going up because it's good for Americans, and we don't like the Russell going down, it turns out, because the dollar is now going down. So again, that relationship has provided for a 4.3% move to the downside here for the Russell from its all-time high, whereas the S&P 500's correction, of course, is less than half of that. Second point would be the 10-year bond yield. In Germany specifically, guess what? It's up 157% since Monday. And some people say, what? And then they say, oh, well, that's off a low number. I don't care what it's off of. That's the point in rate of change terms. That's what we care about. We don't care about absolutes. We care about rate of change predominantly as a risk management factor. But again, that's what's really driving the 10-year bond yield here in the U.S. and worldwide for that matter. So again, no, I don't think that the German bond yield is going to 1%. But again, it went from 0.14% to 0.36%. And that's just a mega move. And again, a lot of people have been very confused with the Fed getting easier and the dollar going down, why bond yields haven't gone down too. That's it. Finally, on volatility, again, I've been saying this for the last really 3 to 4 trading days, and again, this was the big signal to raise cash, which is the risk ranges were widening. That is a key leading indicator in our model, and again, they were widening in foreign currency markets, and they were widening in fixed income markets, which eventually gets to the equity market and the commodity markets. And I think that we navigated the cones better than bad. Going into the Fed, we wanted to be long, and coming out of the Fed, we just didn't want to be there anymore. And I'm not going to apologize for it. This is not an easy game. I don't think I absolutely nailed it, by the way. I'm just saying that this is what I'm going to do from here, which is why you're on this call. Okay, those are your top three things.